Welcome back to the portfolio, everyone. And today we are going over the 5 super fast, high-tech growth stocks, the FAANG stocks that makes up Facebook, Apple, Amazon, Netflix, and Google. And as of late, these 5 stocks have seen a huge surge in share price. 4 of the 5 FAANG stocks have actually hit all-time highs really recently in the past couple of days. And I really believe that this tech run is only going to continue, and these companies are going to reach new all-time highs continuously over the next 5 to 10 years. I believe these companies have such strong fundamentals, they have such strong market share within the consumer market, that these companies are going to continue to grow each and every year over the long term. And of course, if you want to jump in right now, we're going to do a quick evaluation of all the FAANG stocks. We're going to go over the company financials, the balance sheet, the income statement to determine if now is a good time to jump in. And of course, with regard to the FAANG stocks, a lot of people are saying now is not the time to buy because they're at their all-time high. But if you take a look at them at a long-term perspective, and if you can determine that you believe Apple, Amazon, Netflix, Facebook, Google, that in 5 to 10 years, they're going to be bigger, generate more revenue, and worth more than they are today, then it's always a good time to buy these companies. You want to buy companies when their future outlook is strong, when you really believe that their share price is going to grow continuously over the long term. And now, if you believe that with any of these companies, although they may be at an all-time high, it might be a good time to jump in. So when we take a look at these FAANG stocks, we're going to take a look at how large they actually are and how much of the overall market they actually make up. So this is a list of the S&P 500 with regard to market cap. So if we scroll down, you can see the FAANG stocks make up some of the most valuable companies on the market. So you see Facebook is number 4. Apple is the second largest company on the S&P, followed by Amazon at number 3. Netflix is actually down here a little bit at 18, but still in the top 20. And Google rounds out the top 5. So 4 of the 5 largest companies are part of the FAANGs. FAANG, Facebook, Apple, Amazon, Netflix, and Google. 4 of those 5 companies are within the 5 largest companies within the S&P. So we're going to jump right into it. We're going to break down each individual stock to determine if it's now time to buy. But before we do that, I am the Gen Z investor, and every single day I come up with new videos about the stock market. We talk about different stock markets, how the overall performance of the stock market, different stocks you can buy for your portfolio, and any big market news or headlines. So if you please want to like and subscribe, we will jump into the first pick. So of course, we're going to go in order through the abbreviation. So the first ticker in FAANG is ticker symbol FB, Facebook. Currently trading at $244 a share. On the 1-year chart, you can see they are up 22%. They did see those March lows, but have fully recovered and continue to grow to new all-time highs. On the 52-week range, you can see they are right at that 52-week all-time high range, with a market cap very close to $700 billion. This is a tech company. They do not currently pay a dividend, and this is a completely growth play. Facebook's somewhat interesting right now because they've been in the news because of a lot of big companies are no longer advertised on Facebook because the platform has done not the best job monitoring and removing any hate speech promotion within the platform. So you can see here a bunch of different companies, a bunch of big household S&P 500 companies are actually no longer advertising through Facebook. So you can see here companies like Coca-Cola, Starbucks, Unilever, Verizon, Ford, Ben & Jerry's, Denny's, and a couple others have halted their paid advertising on Facebook. Some of them are just doing it for the month of July just to improve a point. Some of them are going to do it for a prolonged period of time. But just something to keep in mind, that a lot of these companies are actually pulling their ads from Facebook. Of course, Facebook generates ad revenue in so many different countries from so many different businesses. We have to wait for their financial statements to really see how much of this has had an impact on them. But it's good to keep in mind that there is a little bit of negativity coming around the company right now. Although the share price is still up 22% year to date, some news headlines show that they may not be in the best position at the moment with regard to how other large companies view them in their perspective of Facebook. If we take a look at their income statement right now, Facebook has a beautiful income statement. One thing I'm going to talk about with all these companies that they all have such strong financial statements. That's why they have seen such tremendous growth. A lot of investors who actually do research on companies, they understand the strength of these companies in their financial statements. And they really believe in the future that they'll have the potential to continue to grow these financial statements year over year. Let's take a look at revenues. 5 years ago, Netflix's total revenue was only around $18 billion. But in the trailing 12 months, they've generated $73 billion. So they've more than 4x'd their revenue in a matter of 5 years. Their net income has seen another beautiful growth. 5 years ago, their net income was around $3.7 billion. Meanwhile, they have close to $21 billion of net income in the trailing 12 months. So it just shows how much Netflix has continued to grow each and every year. It has become, of course, the market leader in the streaming services. And I only believe that will continue to grow as they continue to innovate. Netflix is doing a good job. They're diversifying their assets. They're purchasing other companies. They're also doing a good job. They're actually producing their own shows. Because of the other streaming services that are coming out, they're doing a nice job of producing their own content that they actually own for their platform. It is exclusive to their platform. With regard to their balance sheet, you can see here they have total cash and short-term assets of around $60 billion, which is absolutely remarkable. Total current assets are closer to $70 billion. Meanwhile, total current liabilities are only $15 billion. So you can see they have a current ratio of 4. They have almost as much they have 4 times as much cash on hand to pay off all their current liabilities. So today they could wake up, pay off all their current liabilities, and still have around $45 billion in cash and investments, which is absolutely remarkable. With regard to total assets, you can see here they're around $139 billion. Meanwhile, total liabilities are only around $33 billion. So once again, so much assets on hand, they can pay off all their total liabilities and continue to operate very nicely. And with regard to equity, they've done a beautiful job. They've more than doubled their equity on their balance sheet in the last 5 years. Each and every year, that equity position is growing, which is great to see. Facebook is actually one of the only companies who Simply Wall Street actually ranks as fair value right now. The other 4 tech stocks, Simply Wall Street, their metrics show that they're slightly overvalued. But of course, Facebook, they actually show here that it's actually almost perfectly valued at a fair price right now. And of course, the great Warren Buffett has stated numerous times that it's great to buy a fair company at a great price than it's better to buy a great company at a fair price than a fair company at a great price. So I do believe in buying these companies at fair value, or even if I have to buy them slightly overvalued only because I believe in them long term, then that's okay. The second stock on the FAANG list, of course, is Apple, ticker symbol AAPL, currently trading at $382 a share. You can see insane growth in the 1 year of over 90%. They did see those March lows, but once again, they fully recovered. Nice V-shaped recovery for Apple, and it's continued to reach new all-time highs. Trading at that all-time high, they have an insane market cap at around $1.66 trillion, and Apple actually does pay a slight dividend of 0.86%. With regard to their financial statements, Apple, of course, is another income machine, generating new net income highs every single year. Last trailing 12 months, they've generated close to $268 billion of total revenue. With regard to net income, over $57 billion of net income. So once again, they do a great job of generating huge amounts of net income for the company. Their balance sheet is what makes Apple stand out beautifully. If we take a look, they have close to $94 billion in cash and investments right now. They have a huge bank account, $94 billion. They can do so much with that money. Total current assets at around $143 billion, with only current liabilities around $96 billion. So once again, they have enough cash on hand. They could pay off all those current liabilities and go back to zero liabilities and continue to operate the business very nicely. With regard to total assets, they have around $320 billion. Meanwhile, their total current liabilities are only around $240 billion, so nothing too crazy. They have enough total assets on hand to cover off all those liabilities and continue to operate. Apple has done an okay job growing equity. You could see year over year they were on an upward trend, and then they have seen a little bit of decline over the recent years. Hopefully Apple in the next short term can try to bump that up and grow equity moving forward. And of course, because they do pay a dividend, we're going to see how safe it is considered 99, extremely safe. They only have a payout ratio around 25%, so they do a great job of consistently growing that dividend at a very fast rate. Last year they grew it at 10%, and of course that dividend is extremely safe, not going to get cut anytime soon. Moving on to Amazon, the third stock on the FAANG list, ticker symbol AMZN, currently trading at $3,182. Of course, Amazon is at a 52-week high. And the 1 year chart, you can see they are up 60%. They did not have such a significant drop compared to the other FAANG stocks during the March lows, and they have seen a rapid surge. Over the year to date, they are up 72%, and in the past 6 months, they were up 67%. Third largest company in the S&P right now with a market cap of $1.59 trillion. With regard to their financial statements, once again, it's a beautiful picture. I love looking at these FAANG companies and their financial statements. They are beautiful to analyze. Such strong revenue growth, such strong fundamentals and everything about them. You can see here over the past trailing 12 months, they've generated $296 billion of revenue. 2015 revenue was only around $107 billion, so they've close to 3 times their revenue in the matter of 5 years. With regard to net income, they do operate with somewhat flat net income over the past 3 years, but that's okay to see because they're generating so much revenue and Amazon reinvests so much money back into their business. They do increase their expenses by always funding their cash flow back in to grow into the future. That's one of the things that really attracts me to Amazon, as well as all these other FAANG stocks. They are extremely motivated and extremely dedicated to reinvesting back in the business in order to grow over the long term. So of course, net income is still on a nice upward trend. 5 years ago, they generated only close to $600 million net income. And the trailing 12 months, 5 years later, they've generated over $10.5 billion in net income. So the upward trend, of course, is still here, but over the past 3 years, net income has been somewhat flat. With regard to Amazon's balance sheet, another very important thing to take a look at is they have close to $50 billion in total cash and in short-term investments as well. Total current assets at around $85 billion. And meanwhile, total current liabilities are still around $79 billion. So they do have enough total current assets on hand to pay off all their total current liabilities. Their current ratio still is above 1. Meanwhile, their total current assets are around $221 billion. Meanwhile, total liabilities are around $155 billion. So once again, more assets than liabilities can cover all those liabilities with regard to their current assets and long-term assets. They do want to try to bump up that current ratio a bit to get a little bit better, but that's okay. With regard to equity, they have done a beautiful job of growing equity year over year, $13 billion of equity in 2015, all the way up to close to $65 billion in the latest report. So they've done a beautiful job of growing that nice, solid upward trend, which is great to see. Moving on to the N from the FAANG stocks is Netflix, of course, the streaming service, ticker symbol NFLX, currently trading at $507 a share. Right at that 52-week high right now, that all-time high. On the 1-year chart, you can see they are up 33%. All these stocks follow a similar price chart over the past 1 year. They were all somewhat a little bit upward trend, hit the March lows, and have fully recovered and continued to grow. Market cap at around $223 billion. This, of course, is the smallest of the FAANG stocks, but still comes in of 18th on the market cap weighting of the S&P 500, so still a large company overall. With regard to their financials, you can see how Netflix has done an amazing job of growing revenue. They've 4x their revenue over the past 5 years. In 2015, they had around $6 billion and $800 million in revenue. Meanwhile, in the trailing 12 months, they've generated around $21.4 billion of total revenue. With regard to income, they've done the same thing. 5 years ago, they only generated $122 million in net income. Meanwhile, they've generated close to $2.23 billion in net income over the trailing 12 months. Each and every year, they've grown net income very nicely. With regard to their balance sheet, you can see here total current assets at around $6.4 billion. Meanwhile, total current liabilities at around $7.8 billion. So this is one of the first FAANG stocks that actually does not have a current ratio above 1. They don't have those current assets on hand to pay off all these current liabilities, but I do believe Netflix has the fundamentals to actually continue to generate revenue over the next 12 months, to have that ability to pay off those current liabilities and continue to move forward. So I'm not too worried about that current ratio right now. With regard to the overall ratio, you can see total assets around $35 billion. Meanwhile, total liabilities around $26 billion. So at least that ratio is nice to see. They have more assets than liabilities overall, and they do have the assets in total on hand to pay off all their current liabilities over the long term. With regard to equity, they've done a beautiful job. They've over 4 times their equity over the past 5 years, similar to their revenue growth. $2.2 billion of equity in 2015, up to around $8.4 billion of equity in the trailing 12 months, which is a nice upward trend. It is beautiful to see from these companies. The last and final FAANG stock, of course, is Google, or their parent company Alphabet, ticker symbol GOOGL, currently trading at $1,518 a share. And of course, you can see a 35% gain on the 1-year chart. Pre-pandemic level at around $1,516. So you want to take a look. That's exactly what they are trading at right now. So they saw the March lows and have fully recovered back to pre-pandemic levels. They haven't seen so much of a surge past pre-pandemic levels like the other FAANG stocks have, but once again, they are still back to where they are and are going to continue to grow over the long term. The biggest and most wealthiest people in the world have really talked about how powerful Google is, and I really think it could be a strong position within people's portfolio if they need to bump up their tech stocks and if they evaluate Google and determine it's right for them. Market cap at around just over $1 trillion at $1.03 trillion, which is absolutely insane. If we take a look at their balance sheet and revenue statement, you can see here, beautiful job of growing revenue. They've more than doubled revenue over the past 5 years, trailing 12 months around $166 billion. Total net income for the company has been growing year over year, $34.5 billion of net income in the past 12 months, which is unbelievable to see. Their balance sheet, once again, is very strong, similar to all the other big boy FAANG stocks like Apple. Huge amount of cash on hand with around $117 billion in cash and short-term investments, which is absolutely insane. Total current assets of close to $147 billion. Meanwhile, total current liabilities of only $40 billion. So they have more than enough cash on hand. Their current ratio is above 3. They can pay off all their total current liabilities and continue to operate the business just fine. They actually have enough cash on hand to completely pay off these liabilities without worry and continue to grow the business. With regard to their equity, they've done another great job of growing total equity year over year, $120 billion of equity in 2015, all the way up to $203 billion of equity in the last report. So overall, these FAANG stocks have beautiful financial statements. They've all continued to grow very nicely over the past year, and I only believe these companies are going to continue to grow moving forward. These companies make up 4 of the 5 largest companies in the S&P, and I really believe that the S&P's growth is not completely, but very much led by these 5 companies, and I really believe they're only going to grow and get bigger and bigger over the long term. So even though they may be trading at all-time highs right now, if you evaluate the companies and you believe that they're going to be more valuable in the future, then it still may be a nice time to buy. So of course, I am the Gen Z investor and I post videos every single day. So I will see you in tomorrow's video.